thank you very much for inviting our paper to this conference. This is joint work with Patrick Bolton at Columbia University, Tao Li at University of Florida, and Howard Rosenthal, who is a political scientist at NYU. What we do in this paper is to estimate the preferences of institutional investors, mutual funds, and public pension funds by the way by basically their proxy voting records on the Russell 3000 companies they own. And we do so by using a special model of proxy voting that was first developed for political science, the W-nominate method. But it's a method that in its mathematical structure has been used across various disciplines, marketing, economics, and other type of disciplines as well. So the reason why we decided to focus on institutional investors is because they cast a determining vote in a lot of proxy voting in the economy. They are repeat players, and so they have at least the potential to have an effect on the policies of the companies they are shareholders of, and also they shape a large variety of governance, but also economic and social issues this day. And there is a debate related to this. So what we're going to do is we're going to look at the millions of votes that they cast, and then we're going to map both the institution and the issues they are voting on a two-dimensional space. The first dimension is going to be socially responsible versus profit-oriented funds. On the left, we will have funds that put an emphasis in their voting on social, environment-friendly, and they are more likely to vote against say-on-pay proposals. On the other side, on the right, we are going to have institutional investors that are more money conscious, for lack of a better word. These are usually value investing funds that focus on like tax minimization and are more strictly return maximizing oriented. And I want to point out right now that the interpretations coming out of this statistical model are in the eye of the beholder a little bit. So different people might look at these results and might want to interpret them in different ways. It could be that the reason why we have social versus profit-oriented funds is a matter of preferences. There are certain funds that put non-economic objectives in their behavior and in their decision-making. An alternative that is equally valid based on our analysis is differences of beliefs. So it's possible that everybody wants to maximize profits, but certain funds think that maybe they have more a long-term orientation, and they think that putting environmental and social issue into their voting function actually does maximize return for their shareholders. One thing that we find, in addition to this, on this dimension, is that there is a significant heterogeneity in the positions of funds. So ex ante, we could have expected that all the funds are more or less in the same position, and in reality, we find that they are quite heterogeneous. We also consider funds that vote in the same way as the proxy advisor, ISS. So if you vote exactly the same way as ISS, you're going to be in the center, slightly to the left. You're going to be to the left of the major mutual funds, BlackRock, Vanguard, Fidelity, JP Morgan. And you're going to be to the right of most of the pension funds. The public pension funds tend to be located on the left of this continuum, with the exception of one in our data set, which is the Indiana Pension Fund. And finally, we have a second dimension that is we interpret as a more traditional governance dimension that pits management disciplinarian type of institutional investors versus management-friendly ones. The management disciplinarians are mainly represented by the other proxy advisor, Glass Lewis, and they are mostly public pension funds, but not all of them. So this is the summary. And finally, it was on the top, but it was not appearing. In our interpretation, a vote is ideological, not necessarily if it has a political dimension or not, but in the sense of Converse 1964. So basically, we call voting ideological if we can predict the position that a voter and institutional investors will take on a large set of issues. So based on your ideological position on the line or in the space, we can tell how you will vote on director election, environmental proposals, say on pay, and a lot of other issues. The same way in politics, we can say, you know, if you are Bernie Sanders versus Ted Cruz in the US, we can see more or less we can predict how you're going to vote on a vast series of issues, even if we haven't seen you yet. Okay, so a brief theoretical background. So starting with Grossman Stiglitz and Grossman and Hart, in a competitive economy with complete market, we would expect unanimity among the shareholders of a firm, including institutional investors, about what maximizes the value of the firm and therefore the way they should vote. Otherwise, the company could be taken over. And this is a no arbitrage condition. However, if this is the case, then we have the Milton Friedman result that even if shareholders are concerned about externalities, the best way is for shareholders to take care of externalities outside the company itself and still vote for profit maximization. However, there are most situations in which markets are not complete and also in which takeovers are not an immediate threat. And so in such a case, it is possible that it makes more sense for the firm to address these externalities in society rather than letting it to the shareholders themselves. And finally, there is a paper by Hart and Zingales, a recent paper that actually discusses these issues and starts discussing how should mutual funds and institutional investors aggregate the preferences of their investors, of the people that buy the mutual funds. Okay, this is a discussion that has also been going on in the press, not only with the letters that the BlackRock CEOs send to the CEOs of all the companies, but also in general. Here is a quote from the New York Times. So the idea is that, quoting Larry Fink, many governments fail to prepare for the future on issues ranging from retirement, infrastructure, automation, and work retraining. As a result, society is increasingly turning to the private sector and asking companies to respond to these societal challenges. So this is another motivation for doing this. I'll go quickly through the related literature. There is a longer section in the paper that explains the relationship between our paper and the literature. One thing that I want to say is that there is a very large literature both on proxy voting and on corporate governance in general, and the way this paper connects to it is by using a method that we think allows us to take a wider point of view. Most of the previous literature has been focusing on agency issue, conflict of interest between the managers and the fund, conflict of interest between the fund and the ultimate investor. And this method, being a statistical method and being ex-ante agnostic about what matters, allows us to look at this issue, but also potentially to look at other dimensions that are not immediately shareholder value maximization and agency issues. And then we also connect to the literature that talks about the role of institutional investors in the economy. Okay, so let me tell you the main features of the methodology, and I will probably refer you to the paper for more detail. So we use the W-nominate method, mainly for the analysis, although we do some robustness check. This method was developed by Poole and Rosenthal, our co-author, in 1985 to study Congress. And the connection that he has for at least for economists is the following. So we have a set of heterogeneous voters or players that care about some features of the proposals they are voting on, but we, the researchers, don't know what these features are. So we observe them voting according to their preferences, and we create a statistical model, two-dimensional, one-dimensional, or potentially higher dimension, that puts both the investors and these issues on a map. And then by looking at the map and the position and the identity of the various investors, we are going to interpret and identify what these relevant features that are unobserved are. So this is the idea. This can be implemented in a random utility framework, like McFadden in 1976, and has been used to study how consumers decide between different goods, depending on the features of those goods, about testing abilities of students, and about a large set of other issues. So in our case, and in most cases in this setting, each investor will have a utility function that is single peak. The peak of this utility function is the favorite place on the map for this investor, and it's called ideal point. The investors, if there was only one proposal, would vote for yes or no, depending on whether the yes or no point on the map is closer to his ideal point. So if I'm sitting here and this is the yes and that one is the no, I'd rather vote yes. And how much I enjoy voting yes depends on the distance between my ideal point and the yes, and also my distance to the no. However, there is more than one proposal I'm voting on, and so we will have to sort of trade off me being close to this yes, but potentially being far away from other proposals that matter as well. Once we do this, the funds will be aligned on some dimensions. There will be a small number of latent dimensions, and these dimensions are called ideology, in the sense that I specified before. Okay, so for each fund, we will have one point on the map, and this point is going to be determined by the entire history of voting. And for each proposal, we will have on the map either a point in one dimension or a line in two dimensions that separates the coalitions, separates the funds that are predicted to vote yes from the funds that are predicted to vote no. And by looking at the characteristics of this line, for example, the slope and the position, we will be able to tell for each single proposal that they are voting on, not only the coalitions, but also how much they care about the first versus the second dimension based on the slope. A vertical slope is going to be a one-dimension vote, first dimension, and a flat slope is going to be only second dimension, only governance, management, disciplinarian versus not. How am I doing with time?
8 more minutes.
8 more minutes, okay. One thing that is important to point out, and then I'm going to speed up, is this method is completely agnostic about the identity of the funds and also the content of the proposals. So we interpret that only ex post. Okay, so let me give you a quick example, and then we will proceed. So we will have hundreds of funds, but suppose that this is how funds vote. These 3 funds vote on some proposal, CalPERS, Fidelity, and GAMCO. So for each of these proposals, there is going to be a lot of unanimity. For example, they vote in the same way on 5,257 proposals plus 58. Every time 2 funds vote, every time everybody votes in the same way, we don't know anything about their relative position. We just know that they agree. So in order to put them on a map, we need to find the cases in which they disagree. And so for each case in which they disagree, we need to be able to, first, we start by calculating an agreement score. How many times does Fidelity vote with GAMCO? How many times does Fidelity vote with CalPERS? How many times do CalPERS and GAMCO vote together? And based on that, we put them on the map. Okay, so I'm going to skip this. In a 2-dimensional space, so in a 1-dimensional space, both the funds and the proposals are going to be on the map depending on their relative positions. So 2 funds that vote together are going to be next to each other. The distance between one fund and the other is like a temperature scale, in which we are farther away, then we disagree more. However, we can rescale everything and change that position. This is on the second line. I'll spare you the math. So basically, the idea is that if we had enough computing power, we could actually try over and over where these, I think the mic works better now. We could try over and over to see where these funds are positioned, but we cannot do so, and so there is an estimation procedure that is alternating. So let me show you the first result. So if we align the funds on only one dimension, this is how they look like. So there is the left, there is both pension funds, Domini, Calver, and the socially oriented funds. And then on the very right, there are the value investing fund. BlackRock, Vanguard are in the middle. This is ISS with the 50 funds that vote exactly like ISS. This is Glass Lewis, and so on. And you can repeat this picture. The blue one are the pension funds, the red one are the mutual funds, and you can see how each of the institutional investors is actually positioned relative to each other based on their voting. We did some validation of our interpretation. For example, Domini investment philosophy tells us that social and environmental implications are something that they care about in their voting. The value investing funds stress tax efficiency, capital appreciation. And in future work, we're going to run a linguistic analysis of the investment philosophies of all the funds and the political orientation, potentially, of their employees to see if they align with our measure of ideology. This is the second dimension. So if you calculate a correlation between the one dimension and the the 1 and 2 dimension result for the most important dimension, this is 0.91%. So adding a second dimension doesn't really change the positions on the first dimension and the relative position. However, it allows us to estimate the position of Glass Lewis and a few other funds with much more precision. And it allows us to understand that there is a second dimension in the voting behavior that we interpret as management-friendly versus management disciplinarian. Okay, so let me now, after I told you this result, quicker?
4 more minutes.
4 more minutes? Okay, perfect. Okay, so I think I'll be on time. One thing that we can do, in addition to analyze the position of the institution, is to look at the substance of the proposals and which type of proposals separates different type of coalitions. We do so by analyzing the midpoints in 1 dimension and the cutting line in 2 dimensions. So by definition, a midpoint is the point on the line that separates the probability of voting for versus voting against. So a midpoint tends to be on the left of the line if the coalition is the left against everybody else. As the midpoint moves to the right, then the left gains more and more support from the center, till going toward isolating the right. I didn't mention it, but the position of the management is toward the right. So another interpretation that you can give to these midpoints and coalition is if the midpoint is very on the left, it means that management has wide support for their initiative or for whatever they favor. And as the midpoint moves toward the center, there is more and more opposition toward management, against management proposals. Okay, so let me show you how these midpoints look like. So again, a lot of the midpoints are here, close to -1, meaning that the left is isolated against everybody else. If this was Congress, there would be a lot of midpoints in the middle. Usually Congress breaks 35 versus 65%. Here, the votes are more lopsided. Management tends to get a yes on many more proposals than 35, 65. And so this is why they tend to be on this side. However, there is also a lot of proposals in which management is in the minority. Specifically, governance proposals are such that there is a lot of opposition against management most of the time. On the contrary, compensation, and specifically say on pay, see management getting a lot of support, although there are few significant proposals for which this is not the case. This is director elections, and we see that they are also very much in favor of management, although in the case of director election, even a small fraction of disagreement might be interpreted as something negative. And these are the social ones. They are bimodal. There are cases in which there is wide support for social proposals and cases in which there is none. So we can connect then this proposal and the position of the midpoints to the characteristics of the firm. So for example, if all else equal, the coefficient is negative, we can look at past return. It means that all else equal, a higher past return moves the coalition toward left versus everybody else. So when the company has high returns, the left is isolated in going against the management. If the company has bad past returns, then the left gets much more support in this. Similar effect, the opposite effect is for shareholder proposals that move the needle to the right, and for liquidity measure that also moves it to the right. We interpret the liquidity measure as being companies that have enough liquidity in the market and having the possibility of, for example, activist investor invest in the company and make a change. Board size, having a poison pill, having an equal voting right have also an effect. A larger board size, as well as more independent directors, makes management more liked by the shareholders. Poison pill and unequal voting rights makes the coalition of management all else equal smaller. The midpoint on the second dimension is more balanced. Let me show you the cutting lines instead. So the cutting lines have the same interpretation as a midpoint, but in 2 dimensions. A vertical cutting line is a cutting line in which both management disciplinarian and management-friendly funds don't care about the issue along that dimension, but they care left versus right. And so is the other. So this is an example, and maybe I can close here. So this was the say on pay vote in April 2017 on Citigroup, in which Vikram Pandit proposed compensation was voted down, or at the 55% no, coming from shareholders. And here you see the coalition. So the point here are the institutional investors and their predicted vote based on the entire history of voting that we analyze. And the cutting line is specific to this proposal. This side are those that are predicted to vote against. Glass Lewis, ISS, both suggested to vote against, and these are the predicted opposing funds. Notice that BlackRock is slightly supposed to vote no, and so Vanguard, and these are the ones that are supposed to vote yes. These are the errors. So this is another way to evaluate the fitness of the model. How many errors do you have? How many funds do you mispredict? And also, where are these funds? If the funds are very close to the cutting lines, these are funds that are pretty much indifferent between yes or no. The ones that are really on this side, they are just slightly leaning toward no, based on their ideology, and the one on this side are leaning toward yes. So these are not very important errors, and the statistical methodology indeed underestimates them. However, for example, this is a large error because the Massachusetts Pension Fund was supposed to vote against and instead voted in favor. And so we can also analyze this dimension and try to understand what potentially push a certain institutional investor to vote against, whether it's an error or it's a strategic component as well. So I'm out of time. There is much more in the paper, but I'm going to stop here.
I hope this will work. It's a pleasure to discuss this paper by Enriqueta and her co-authors. I will have 3 points to make about this paper. The first one is I want to compare it to another competitor paper by Bubb and Katan, as it's Ryan Bubb and Emiliano Katan, The Party Structure of Mutual Funds. I have the luxury as a commentator to just be able to benefit from both papers, and I'm not in the unfortunate position of the authors who, of course, for the referees, have to differentiate their paper from the other papers. I can tell you they're both great papers. If there are any referees or editors in the room, you should publish both of them, and I'll tell you why. All right. Then I'm going to talk about interpreting the results, which actually ultimately is the biggest difference between those 2 papers, although I won't then talk about the other paper. I'll talk about, in particular, the interpretation of the first dimension as ideology, and then I have some other observations and suggestions at the end. So let me start with the comparison of BLLC, that's Enriqueta, and BC, that's the other paper. Why is it BLLC? All right, sorry, BLLR. Am I still wrong? Yes, I'm still wrong. I don't know. It was late at night. Anyway, the first paper is Enriqueta. The second one is the other paper. Okay. So I put a couple of differences in how they go about this task of looking at these votes and reducing the dimensions on this table. You can go through them and you'll see that many of them look a little bit different, but they're not very different. And there's actually only 3, I think, or 3 or 4 where I really see differences. One I put on the top. I'll come back to that. Enriqueta and her co-authors, they also look at public pension funds, whereas the other paper only looks at mutual funds. I think it's a very nice touch. The level of aggregation where they look at is different. Enriqueta and her co-authors, they look at fund families. The other paper looks at funds or fund advisors. Those are not the same thing, investment advisors. And then, of course, the method. Enriqueta and her co-authors, they use this W-nominate method, which ultimately is maximum likelihood estimation of ideal points for funds and positions of proposals in the same space. And the W-nominate is really just an algorithm of how you estimate this extremely high-dimensional maximum likelihood model. Whereas the other paper uses principal component analysis and then picks out the two first components. And then there's some complications of estimation. As you can imagine, there's lots of votes and lots of funds, so this is not a straightforward computational task. You couldn't just run it on your laptop in 3 minutes. This is going to be more complicated. But anyway, oh, maybe there's just one more note. You can look at both of these methods as pure dimension reduction, or you can link them to a model of behavior, of preference maximization that works for both of those models. When you make that second step, you have to make certain assumptions about what the preferences are and what the errors look like. And you need independence assumption and you need parametric assumptions. They're probably both false for both models. But I think it doesn't matter because the real interest here is the dimension reduction. So let me talk about that. The results, even though the methods are different, the results, comfortingly, I think, from my perspective as a consumer of this research, they get the same results. It's comforting because I don't have to decide which is the better method. Let me show you that graphically. So this is the graph you know from Enriqueta's presentation. It shows the funds in 2 dimensions. I've highlighted some important ones. And then next to it, I'm putting the sort of the equivalent graph from the other paper. And when you look at it like this, I don't think you can really quite make out what's going on here, but let me help you. I'm going to strip out some stuff. I'm going to mirror the image on the right across the y-axis. I'm going to turn it. I'm going to stretch it. I'm going to stretch it more. And then I'm going to highlight these funds. And now if you inspect the position of the respective institutions, I think what you'll find is that starting with the vertical axis of Glass Lewis, ISS, got Glass Lewis, ISS, and then relative to that, BlackRock, Vanguard, got Domini and Calvert, Yes, are there differences in the details of how far these things are spread out here relative to the center and how big this distance is here relative to the distance from the center? Yes, there are such differences in details. If you care about those differences, I think you have to believe very strongly that the model is very, very, very precise. I don't believe that, so I'm happy to just state that the overall picture looks very similar. Those clouds, they have a very similar shape. You can see the same picture emerges from both procedures, which again, I understand, when you're the author, you have to differentiate yourself, but for me, it's great. I think this is fantastic. 2 different methods, we get the same result. There are more formal ways of comparing these 2 models, and if you know in the machine learning literature, which this is sort of going into method-wise, you would talk about prediction accuracy. I'll put the main numbers on the table. They're both pretty good. Of course, these are in-sample numbers, so it wouldn't really count in the machine learning literature, but they're doing a pretty good job of classifying those votes using only 2 dimensions, which I do think is quite remarkable. It's a great thing that the paper is showing that. Okay. Then what the papers are doing differently, and I think, again, it's great for us as consumers to see both of those papers do these things. They have different extensions. So Enriqueta and her co-authors I'm happy to say that I'm back to the right letters there, BLRR. They are looking at how firm or director characteristics predict where the proposals will be located in that 2-dimensional space. Whereas the other paper looks at how fund characteristics will determine or predict where the funds are located in that 2-dimensional space. Those are both interesting perspectives, and so the papers are really complementary in that sense. The other paper also does some formal clustering. I'll spare you that. I already mentioned that Enriqueta and her co-authors, they have the public pension funds. I'm back at the wrong letters, so that's a great touch. But I think the main difference of the 2 papers is that they interpret the first dimension differently. So let me talk about that first dimension, the ideology in the terminology of Enriqueta and her co-authors. Just one aside, point that both Enriqueta and her co-authors make, and the other paper makes, is that institutional investor votes are far from reflecting shareholder unanimity. And I had the same reaction in your paper as I had with the other paper. Yeah, of course, by construction, because you filter the sample, you kick out all the votes where they are basically unanimous, which is a lot of them, and you only focus on the ones where there is disagreement. Of course, you'll find that there is disagreement. That's not, it's not surprising. Even so, even in those votes where you do have some disagreement, the agreement is actually extraordinarily high. You mentioned that relative to Congress, where in Congress we see 50-50 votes or 65-35 votes. Here, the average vote for a proposal is 85%. That's mixing together proposals where the average vote for is 5%. So the rate of agreement, even within this sample that's filtered to have disagreement, the rate of agreement is still very, very high. So I'm not sure that I don't think we learn from this analysis that there's lots of disagreement. The one thing I think we do learn from it is that the disagreement is predictable. We know who's going to be on which side, which is something important, but not the fact that there is disagreement. Okay, so now the real thing, ideology. There is the paper, I think, has two faces or two embodiments. One is the Dr. Jekyll version of ideology, and it's a very innocuous version of ideology. I'm going to give you some quotes from the paper. Nominate is agnostic as to where ideology comes from and what it represents. It does not, per se, make any substantive interpretation of ideology. The choice of polarity, left-right, is arbitrary. The meaning of ideology is in the sense of converse. Voting behavior is ideological when voting across a wide set of different issues is predictable. Now, predictable, then you might imagine, if that's really what it's about, you might imagine a different title for the paper, not investor ideology, but investor voting predictability, which is, somewhat different title, or perhaps reflecting the last quote, presumably because an underlying belief system binds voting preferences over these issues together. So, for example, it could be a paper with the title Investor Belief Systems, because they have different beliefs. And those beliefs could be about all sorts of things. For example, about the question, are staggered boards good or bad for corporate performance? Which is not your usual ideological question, but it's certainly a question that investors might care about and have beliefs about, and then they might be predictable in their behavior based on those beliefs. Now that's all very agnostic and neutral stuff. And who could quibble with this? This is definitely correct. Now comes Mr. Hyde. And of course, when you use the word ideology, I think, at least for me, the word ideology, it's loaded. It's not a neutral term. It's not a term that you just, you create an artificial, you grab some word from ancient Greek, heteroscedasticity, and you give it some meaning, okay? So this is ideology comes with baggage, and left and right come with baggage, and so if you invoke it, of course, you're saying something, and that's very explicit also on the paper. It starts off in the introduction, that this is, these votes are beyond pure shareholder value considerations. The left represents relatively socially oriented investors, while the right represents more money-oriented investors. Socially versus money-oriented, just like legislators' ideologies. That phrase is in the paper. So here, the notion of ideology is invoked as a very charged one. And I'm not against it, but I'm just saying that requires then some work to think about why that attribution is accurate. Last one, the left may be more open to lowering shareholder returns in ways that promote environmental and other social objectives. On that one, I would also add that if that were true, those investors would all be breaching their fiduciary duties, and they would expose themselves possibly to personal liability. I mean, assuming that this could be proven. So again, I'm totally open to the idea that they are doing this, but I also think that we ought to give them the benefit of the doubt, perhaps, or at least we should look at this very closely. So let me look at this ideology question in two ways. I'm going to start with the evidence. How do you, we know from both Enriqueta's and the other paper that you can align investors along those two dimensions. The first dimension, whatever you call it, has a lot of predictive power. And so what is the evidence for calling it left, right, or political, or social, or whatever you want to call it. One piece of evidence that I can think of, and that's in the paper, is that public pension funds, and again, nice touch to have those in the paper, the public pension funds, that they are on the left on this first dimension, and perhaps, therefore, left means political left, just because public pension funds, one might think they are on the left politically. And there's a quote in the paper saying it's to be expected that public pension funds have different ideologies because they may have a duty to vote in line with their members' preferences. And, I don't know, if they're all teachers and firefighters, then maybe they're all on the left, I don't know. But in any event, what I can tell you, at least from a legal perspective, that is not the case. Public pension fund managers have a very clear duty to maximize financial returns, and financial returns only. I'm not stupid. I understand that the reality of many public pension funds is that they might sometimes do something somewhat different. I'm just saying, from a legal perspective, it's very clear that they have to maximize returns. And public pension plans, they are the biggest investors in private equity funds. They're very large investors in hedge funds. It's not like they're all like cozy people who are just investing in solar energy, right? They want to make money too. So then the question is perhaps a little bit more abstract, and looking at the data itself that you have, does dimension 1 only predict political left-right choices? Now, if that were the case, then it would be, I think, easy to label it as a left-right ideology in the usual sense of the word. But that's not the case. The first dimension predicts everything, including director elections, governance choices, and compensation votes. And now it is true, I think, that those things have some correlation with political views, but those correlations, I would interpret them with great care. So if you think, for example, one of the governance issues that must be in your sample is staggered boards. That was still going on in 2012. Now, one type of investor that is very much against staggered boards, along with those other investors on the left, is activist hedge funds. I don't think activist hedge funds could be called to be against, they're very money-oriented, but they have certain views about how one is supposed to make money. So again, I would just be, I'm not saying that I have a strong view against the political interpretation. I'm just very skeptical, and I think I haven't seen the evidence yet that would allow me to call that first dimension political or social. He says some more words about this, like even if dimension number 1 only predicted ESG and did not predict those other things, director elections and so on and so on, I still would hesitate to call it social in the sense of an ideology of the fund or the fund manager, because first of all, it could be a belief about the financial value of ESG. Now, at least the official position, and again, I'm personally extremely cynical about this official position, but let's give them their due. The official position of investors who are pushing ESG concerns, like institutional investors pushing ESG, is that it's good for financial value. They say things like, and those are from the paper, about the 2 outlier funds, we apply ESG standards believing they help identify strong financial rewards. Or the other one, the firm seeks to generate favorable investment returns by capital allocation consistent with ESG. And so I would hesitate to interpret it that way. The last thing I'll say, it's also possible that the investment managers themselves, they have no ideology, but they have different marketing strategies of the ultimate investors that they're appealing to. And I'll just leave you with this little slide. This is it's not about ESG. I'm just saying, for ESG it's very obvious, but even for voting against management, this is from Legal and General. LGIM votes against a record number of companies in 2018, and then just to drive home the point, they'll say that this documents their quality of engagement. So if you're a good steward of your investment, then you vote against management. I'm not sure that they believe this, but they certainly put this out there as a press release, and they try to convince the public of this. All right, I had 2 more comments, but I'll skip those, and again, thank you for the great paper.
Thank you very much for the very thoughtful discussion. I will be very brief. It's very appreciated. So there is another paper, Bab and Katan paper that was posted a couple of weeks after ours. We are very happy that there is interest in this area, and so more and more people work in this. So it was great for us. I agree the difference is not much the methods, but mainly the interpretation. And we are happy about this as well. First dimension. So. So we kick out unanimous votes. They are significant, but by far not the majority of the votes. But I agree with you that if we consider also the unanimous votes, there is definitely more unanimity in shareholder voting and institutional voting than there is in Congress, that's for sure. However, before starting this project, we really didn't know where would BlackRock fall on the line compared to Vanguard, compared to other funds, and why that was the case. So we think it's interesting to have this exploration and try to understand why that happens. Thank you about the comment on fiduciary duty. Maybe the fact that the large funds are in the center might be correlated with the fact that maybe since the funds are on pension menu, like 401k menus, they might have a stronger fiduciary duty. What else does the first dimension predict? So we're working on collecting more evidence about the mission statements of this fund, the investment philosophy, and the political views of the employees. We don't have activist hedge funds. One possibility is that there is maybe a smaller political dimension, like first dimension in their vote, and maybe there is a stronger second dimension. So it would be interesting to know that data. This could be a marketing tool. In general, funds could be voting strategically. So our methodology, like any other methodology for Congress and anything else, tells us the view that they communicate through their voting to the public. But that could be marketing, could be voting with the management, maybe not to rock the boat, or in exchange of something else, and that would still be something that is communicated versus the intrinsic ideology of the fund. Thank you so much for the discussion.
There's an interesting business overlay to this, because most but not all of the people in anybody's sample are in the business to make money. There's a big difference, for example, between the public funds and everybody else in a simple way. That is, the public funds have locked-in investors. So the investor preferences, the role of the pension fund as an intermediary disappear. If one looks at the governance process for, say, helpers, it doesn't look like anything we would like for a governance system. So you're getting a set of, I think, accurate ideology with respect to the public fund. Once you move away from the public fund, then you've got a group of private funds who are trying to make money. And the one thing that we know about the economics of the business is it's driven by assets under management, right? Huge scale economies. So if we look at what drives assets under management, at least over the last 8 or 9 years, it's performance. It's just straight performance. In the last 3 years, the top 3 performing firms quarter to quarter get 80% of the assets under management. So there's not a lot of room to move away from however they're going. There's not a lot of room to move away from performance and still be in business successfully. The exception being the ESG funds that are on the left side, or depending on how you turn the cloud, who have a different market. And for them, they're playing to a market that will trade ideology against performance. And one could track assets under management among those groups I'm wondering in all of this, the overlay of the business models of the intermediary funds, if you overlay that on top of this, you may begin to get a sense of whether any of it actually matters in terms of either their performance or whether they're making any money. And that seems not to be present in anything.
Thank you very much. I agree that it would be interesting to look. We don't have a long time series enough to look at performance, but and compare the performance on the left versus the right. But I believe it would be interesting to look at the return performance sensitivity of the flows. So, you know, on the left, if they have this other component that is social, then there should be lower sensitivity than on the right when you attract funds, like investors that are more interested in pure return maximization. Another thing related to this quickly is that here we look at one dimension of governance, which is voting, but there is also the idea of voting with your feet. So maybe you buy certain companies and you don't buy other, and this could be related to your expectation of future returns as well as either dimension. And I think the two interact as well. Thank you.
Just to put on the table an alternative interpretation, focusing again on this issue of interpretation. And the interpretation that I would favor is one that is based on an agency cost perspective. So basically, and I'll discuss it when in my talk, but from that perspective, you would say the funds are not political creatures driven by beliefs. They are economic animals driven by their incentives. Now, we argue that one strong incentive that they have is that they might have incentives to be differential to managers. But when we analyze those incentives, we see that they differ in magnitude and strength among different funds or fund families. If that's the case, then you would expect indeed to have a partition, but the partition is in terms of the strengths of the private incentives you have to be differential, and then if you don't have strong incentives, you'll generally be differential. If you have if you don't have strong incentives, everybody understands. I'm only the one that is getting confused. So now, and that will also explain Holger's puzzle, because in our analysis, we say the hedge fund activists, they have incentives to be non-differential. They have very weak incentives to be differential to the managers. So therefore, you would expect them to oppose, not because of their different views of money and life and the pursuit of happiness, but because of how systematically differential. And then if you look at your results, you'll see that the patterns can be, the results are very interesting still, but you can just reinterpret them as the dimension is not left versus right, but difference to managers or not. And the explanation might be the strengths of the incentives you have to be differential along the continuum of the factors that we identify driving it over there.
So we definitely, so this, you make a good point that incentives are important. And what I would say is I think that is our methodology helps you understand maybe where some of these incentives come from or how the two dimensions interact. For example, you can be pro-management on the first dimension, and then you would be sort of return maximizing fund. But you could also be pro-management on a second dimension, and then you would be lax on governance, for example. And so there are different ways of being pro-management, and I think our methodology highlights this way. And maybe different incentives guide how close you are to management on the first dimensions versus the second dimension. So this is something that we definitely want to explore more.
Are there any further questions? Yes?
So I want to follow up on your predictability side. So from the point of view of an activist hedge fund, the first thing they do is try to identify a company with performance problems. Then they think about whether they have a strategy to reverse those performance problems. And the third thing they think about is, can we implement that strategy? And they then look at the shareholder base, and they have proxy solicitors who will tell them, well, you've got this group of shareholders. We think that you've got a good chance or you have no chance. Can you do better than a proxy solicitor in predicting how it's going to work out if you're, say, an activist hedge fund challenging? I mean, can you look at, say, the shareholder base 30 days out from the meeting and predict what's going to happen in the director election?
Okay, so this method doesn't have, so yes and no. First, we don't have activist hedge funds. We would like to have them, but we don't. We think that we can definitely try for each. We can look at post at the coalition in the director election and see how many funds voted according to our prediction and how many funds they didn't. And our measures of fits that Holger mentioned indicate that the models are quite robust and actually quite good at doing that. Overall, so that's one thing that we think. We also tried taking out certain data versus other, and we find very, very robust results. So we can, I don't know with what precision, depending on how many voters also we are covering in our method and how many activist hedge funds there are. Touching on the idea of deciding which companies to invest in and whether you can make a change, and based on that, one thing that we are thinking of doing is comparing index funds that don't have the luxury of saying I invest in a certain company because they have to invest in the Broadex index, so they don't have the entry-exit dimension that is so strong, to other funds that are more specific. And to be honest, they are on the very left and on the very right, and those are the funds that actually can not only vote, but they can also buy and sell the positions that they have more easily.
Great. I think we have time for one more question.
Oh, no, so.
Thank you, Mr. Anfänger. I have difficulty with the definition of first dimension that may have been so some time ago. But now, I think all big investors that matter, whether they're pension funds or different,
they don't sort of separate social and environmental with say on pay. This is sort of a standard exercise, and we don't have this kind of either here or there. So that, I think, is one remark. The other one is that more and more it comes out that the papers and the press say, the ISS and Glass Lewis are so super important. For example, in German papers you see ISS governs the vote. Totally wrong, because the real big ones, they use ISS as a service, more or less, right? But don't expect that BlackRock or Norges or all the big ones would, for example, in case of Bayer, would ever listen to what ISS sort of says. And so I think this is an important point also for the future discussions, that we are getting less sort of reliant on saying ISS has done this and that and so on. Okay, thank you.
Thank you. So we indeed find that not all the funds do follow. We agree 100% with your comment. Not all funds follow ISS. Large funds don't. Sometimes vote with ISS, sometimes with Glass Lewis, sometimes in different ways. And it's difficult to tell what it means for ISS to suggest a vote, because they are also collecting the preferences of their subscriber in addition to forming independent ones themselves.